This is section 1.3, determining who owns the risk of loss. And you may ask yourself, why is this important? Why do I need to know, who bears the risk of loss in a foreclosure situation? And the answer is that generally the entity that bears the risk of loss is almost always they're the decision maker, right? So knowing who bears the risk of loss helps you understand what they're bringing to the table in terms of what they're going to require of the homeowner, and in them trying to curb their own losses. So knowing who owns the loan is critical to the workout agreement process. So just to highlight a few, after a foreclosure sale, who recovers the loss? So FHA, so the Federal Housing Administration, they bear 100% of the risk of loss for mortgages that they insure. The VA is the same way, 100% stake. And you'll notice that in terms of the workout options that are offered, FHA and VA tend to be a little more quite a bit more flexible than conventional lenders or even some of the other GSE lenders, because they own 100% of the risk of the loss. So they have more at stake, so they have more invested in terms of how they make sure that their servicers are correctly servicing their loans. Private mortgage insurance, that's going to vary. It's anywhere from 30% to 50% in terms of if there's an additional private mortgage insurance policy. Fannie and Freddie Mac loans, the percentage is not recoverable. The servicer bears the risk. So Fannie and Freddie have mostly existed just to provide extra liquidity in the mortgage market, but they do put the onus on their servicers in terms of bearing any losses associated with their loans. Portfolio loans, so this is also known as like a conventional loan, but portfolio loan, it's owned and serviced by the same entity, so that percentage is not recoverable. The servicer is going to bear the risk of loss. Basically, they own it, they service it, they have their own programs in place for what they'll accept for workout options and what they won't. And therefore they bear 100% of the risk of loss as well. And then for individual servicers, it depends on the servicing contract. So now there are quite a few non-bank servicers out there, your NationStars, Ocwen, quite a few others that aren't traditional banks in terms of having bank charters, but they do service mortgage loans. So their risk of loss is going to depend on their servicing contract. That's something you're probably not going to be privy to, but if there's an investor guideline for what your client would get denied, for example, you do have the right to have your borrower get that information. Okay, so now I'm going to have you pause your PowerPoint, go to activity 1.3 in this section, and then you're going to complete the answers on your own. And then when you're done pausing here, we're going to go through the answers really quickly. So go ahead and go through those. And while you're doing that, I'm going to switch. I'm going to switch over to this so you can see what I'm doing, what I'm on as well. So activity 1.3, the first example. Basically, the question in this activity is who's getting what from a foreclosure sale. So in this first circumstance, example 1, we've got a fair market value of a home at $100,000, a $65,000 sales price of the home at the foreclosure sale, and then $20,000 first mortgage and foreclosure costs. So think $20,000 is everything that the bank is owed on this particular loan. So the first question is, how much does the mortgage lender get from the sale of the home? So they sell it for $65,000, the bank does. They're owed 20 grand. How much do they get? The answer is 20,000. They actually cannot get more than what they're owed. Most state laws indicate that any surplus is supposed to go to the homeowner. So I've had cases before where borrowers petition the court to get those surplus funds back, and typically they have to do that formally using an attorney, or they could even do it themselves. They just have to do it correctly. Number two, what does the purchaser get? Well, they're getting a home worth $100,000, right? Even though they paid $65,000, they're getting a discounted value, which is not untypical or atypical in a pre-foreclosure sale or something like that. It's very common for the bank to accept less than, sometimes even less than what the home may be worth. Although I will say that most of the time they will get their own broker price opinion or appraisal and try to get what the maximum value out of a property. So it's possible in a short sale situation they'd say, hey, wait a minute, this home's worth $100,000. We're not going to accept anything less than $98,000 from an offer, even if it's short of what's owed. Question 3, how much does a former homeowner get? As we indicated, there is a surplus. Here the surplus is $45,000, so they'd have to petition the court for those surplus funds. Okay, so example 2, we've got a $100,000 fair market value of a home, $70,000 sales price at the foreclosure sale, $60,000 first mortgage and foreclosure costs, and then a $10,000 property tax lien. The first question here, how much does the mortgage lender get from the sale of the home? Well, it sold for $70,000. They're owed $60,000, so there's enough for them to get paid in full. They get $60 grand. Number 2, what does the new purchaser get? Again, they're getting a discounted value. Basically, they're buying a home for $70,000. The fair market value appears to be $100,000, so they've gotten a really good deal. Number 3, how much does the taxing authority get? Well, you see there was a $10,000 property tax lien, which is a second in line after the first mortgage. So it's sold for $70,000. The $60,000 gets paid to the servicer, and then we got $10,000 left over. That's exactly how much is needed for the taxing authority to get paid. So they get 10 grand. Now, if you change that up a little bit, and let's say the property sold for $69,000, the taxing authority is only going to get $9,000. That other $1,000, they're just going to have to eat the cost of that. They're not going to get that back. Number 4, how much does a former homeowner get? They don't get anything in this situation. Both of the debts owed on the property had to be fully satisfied in the sales price, so there's no surplus. They don't get anything. It's possible that they were able to conduct a short sale, and that avoided them having to pay anything additional. But usually, when there's a property tax lien or something like that, it usually will prevent a liquidation option like a short sale or a deed in lieu. And then the last example here, example 3, we've got a $100,000 home value or fair market value, $90,000 sales price of the home at the foreclosure, $95,000 in first mortgage and foreclosure costs, and $25,000 second mortgage lender, so probably a home equity line of credit. The question is, how much does the first mortgage lender get from the sale of the home? They're owed $95,000. The property sells for $90,000, so they get 90 grand. So they lost a little bit of money. So you can see there's risk involved too. It's very, in my state, I'd say it's fairly uncommon for borrowers to get surpluses. Usually foreclosure results in a deficiency judgment against the borrower. So usually the bank doesn't get paid everything they're owed. So in this situation, it's possible that the bank would retain a deficiency judgment for that extra $5,000 they didn't get paid, and that's going to sit there on the borrower's credit, and they're either going to have to pay it or deal with it in a bankruptcy. Question 2, how much does the second mortgage lender get from the sale of the home? They don't get anything, right? It's sold for 90. The first person in line was owed 95. They didn't even get paid in full, so the second mortgage lender gets nothing. And that helps you to understand that sometimes you'll see second mortgage lenders either not really attempting collection at all or offering to completely write off the account. Sometimes they acknowledge that they're completely unsecured in their position. So it's a riskier proposition to be a second mortgage holder. How much does a former homeowner get? Again, no surplus, so they don't get anything here. Okay. So that is the end of section 1.3 in determining who owns the risk of loss.